Well, welcome to this Flip It Friday video series. And today I want to start a series that's going to be talking about the time value of money. And today we want to do a mortgage calculation. So how do you come up with a mortgage payment or any other variable? And when you're looking at a mortgage calculator, whether you're using an HP 12C, a 10B, a Texas Instruments, whatever, or using an online mortgage calculator or an Excel spreadsheet that can do calculations, there's many different tools for actually doing the calculations. It's what the important part is understanding what the values and what the numbers really are. So on most calculators, you're going to see the numbers P and I, that's for principal and interest. The N is going to stand for the number of payments. The I is for the interest, and the PV is for present value. And now there's one more that you might see on a lot of the calculators, and that's going to be the FV, future value. Okay, well the primary four that we want to work on are going to be these: the principal and interest, so the monthly payment, the interest, the number of payments, and the present value. Okay, so we're going to run a quick scenario here and go over these values so you can see how we get to a number. And this is how the mortgage brokers figure it out too, the loan officers, when they're calculating a mortgage payment for somebody. So for example, let's say we've got, I'm going to just throw some numbers up here real quick. We're going to want to calculate out for the mortgage payment, but let's say we know there's going to be, it's a 30-year mortgage. So a 30-year mortgage or 360 payments. Okay, so 30 years or 360 for the actual number of months. And let's say it's 5% interest, and we're going to calculate on a $100,000 mortgage balance. Okay, well what is the monthly payment going to be on that? Well, when you run the numbers on a calculator, the principal and interest is going to be $536.82. Okay, and that's because we know three of the four. So now it doesn't really matter which three of these four you know. You can determine what the fourth item is. So for another example, and this one's very common when it comes to mortgage brokers, and I already wrote down some numbers here so I didn't have to waste time. Let's say the mortgage broker, the loan officer, did your debt to income ratios, and they determined you can afford $832.54 a month for your monthly payment. And it's going to be based on a 30-year mortgage or 360 payments. All right. And then the current interest rate is, say, at 4.5%. Right, so those are the numbers. You can afford $832.54 on a 30-year mortgage at today's rates, 4.5%, or whatever the rates are going to be at that time. You can calculate by putting in A3. You can calculate out the fourth, and in this case, it's going to be $164,000. So 164,311.06. So that is the most a person could qualify for based on these numbers. So once you learn how to use a mortgage calculator, then we can take it to the next step and try and figure out future value, which would be balloon payments. We can figure out discounts and yields, and there's a lot more cool stuff that we can do with a calculator once you understand these, and we'll cover those in the next videos.